Hey folks, welcome to a brand new episode of Smart Money. Since it was Women's Day this week, we decided to go full throttle into giving you some advice on how to approach your finances. If you are a woman, if you haven't started investing yet, in fact, this is a topic very close to our heart. We have a campaign ongoing, which is Future Female Forward, where we're trying to embolden and enable women to take all their decisions, whether it is with respect to finance, health, gender parity, and a lot of issues that need to be addressed. Our expert today is Mrin Agarwal, who is a financial educator and director of Finsafe India. She's been doing a lot of work to help women get, financially literate and take charge of their money. Well, Mrin, thanks a lot for joining in. Now, it's a well-known fact that women tend to go in for safer investments, right? For generations now, our mothers, grandmothers would always invest either in gold or in fixed deposits. How do you sort of look at that changing over the next decade or so?
So good afternoon, Sonia, and thank you for having me here today. I think for the longest of time, women have always been associated with safe investments. And I think it's really the fear of losses and wanting to have more financial security that gets them, to invest in gold. But I think the good news is that now we are seeing more women interested in investing into equities. Even in all of my sessions, I'm seeing more women coming, more women asking questions about what sort of equities should they look at, and really, looking at financial independence a little bit more strongly as well.
Okay. So as I said, right, it's very typical for women to invest not just in fixed deposits, but also in gold, in insurance schemes where they've lost a lot of money as well. We just want to clarify, are these good investments or not?
Well, see, whenever you're investing in any instrument, you need to see whether it's really beating inflation, because if it's not beating inflation, then your money is really not growing. So when you look at, I'm completely against investment linked insurance schemes, of course, because they just do not beat inflation. I think fixed deposits in gold to an extent are okay, and for specific reasons. So, for example, fixed deposits always work well for the short term, 1 to 2 years. And currently, of course, you've got some great deposit rates that are available from various banks. Of course, gold also has its own utility to an extent. The point is that, again, these are not investments that you should go overboard with and form a core of your portfolio.
Okay, I take your point about FDs and insurance schemes. I mean, there is a lot of money to be lost there. But gold has done really well, right, Mrin? If you look at the last 1 to 2 years, gold has outperformed equities. In fact, in every recession in the last 7 out of 8 recessions, gold has done much better than equities. So why then do you say that it's not a high-yielding instrument? And from here on, what is your advice on gold?
Well, when you look at the long-term performance of gold, I think in the last 40 years, for example, if you see the returns in India, I think it's somewhere in the range of about 8.85%. Whereas if you look at a Nifty return, it's in the range of about, I think, 15%, with inflation being about 7.6%. So I think, those numbers tell for themselves. And a lot of the gold performance that you see in India is also due to rupee depreciation. So, yes, while it has beaten inflation, and while it certainly has a place in people's portfolios, the whole point is that equities have far beaten inflation much more than what gold has, and which is why you do need to have more equities in your portfolio.
Okay, just one more question on gold since we're on that topic, right? And then we'll move on to equities. If someone wants to buy gold now, and we've done a couple of videos on this as well, the most prudent way to get into gold would be perhaps sovereign gold bonds, because you don't have the issue of safety, security of, looking after physical gold. There's no making charges as well. But do you agree that sovereign gold bonds are the way to go, or do you think even gold ETFs is another way to explore? What's the best way to approach gold now?
Well, I think I would say 3 things on gold. One is limit the exposure to gold to 15% of your portfolio, which in any case, I think most Indians have. The second thing is that buy only as much physical gold as you think that you need for your personal use. And if you're looking at gold as an investment, why I like SGB is for all the reasons that you mentioned. It's zero cost. It gives you tax-free returns at the end of 8 years. And of course, it's sovereign issued as well. So that's what works in its favor. But the issue is that there is that 8-year lock-in, and of course, after 5 years, you can go and sell it. I think if you want a little bit shorter time frame, and if you want more liquidity, then you can certainly look at gold ETF. But overall, when you look at the returns, I think SGB has given the best returns in all of these three options of gold.
Okay. Since you are not in favor of investment-linked insurance schemes, right? You started off by saying that don't invest in insurance schemes. You are all set to lose money if you do that. What are the good alternatives? Tell us, where should women put their money if they're just beginners?
So I think first, one scheme that I really like, and I think people should take advantage of it. In fact, I've been getting a lot of queries on some of the capital guaranteed plans that are there. And I think a better scheme that exists compared to the capital guaranteed plans from insurance companies is a target maturity fund. Because when you look at a target maturity fund, so let's first talk about what it is. This is firstly a passive debt fund, which basically invests in bonds linked to a particular index. Now, this index typically consists of government securities, state development loans, and it also consists of typically AAA rated PSU bonds, right? So the fund is basically replicating this particular index. And again, the biggest advantage of this scheme is that it's open-ended, right? So compared to fixed maturity plans, which are close-ended, while this scheme has a maturity date, it is open-ended, which means that you can exit when you want to, right? Now, the advantage over here is that you're getting a very good quality portfolio. You're also getting it for a shorter period of time. So, for example, you have target maturity funds available right from 3 to 4 years onwards, going to about, let's say, 10 to 12 years, right? So you have a broad range of timeframes that are also available. And the way the target maturity fund works is that it basically buys these bonds and holds it to maturity. So this allows for a fair bit of returns visibility for the investor. Now, when I look at the returns right now on a pre-tax basis, I think we are looking somewhere in the range of about 7.5 to 7.75% on most of these bonds, which I think is a very good return, because if you invest before March 31st, you're also going to get the benefit of that additional indexation. And hence, a very, very tax efficient product. I think on a post-tax basis, you're looking at anywhere between 6.5 to 7.1% post-tax sort of returns, of course, depending on the maturity of the bond. And I think that's a great return to basically tie into, as compared to getting into a scheme, capital guaranteed scheme, which is much, much more expensive. So I think the first one for people who really want to play it very safe and who do not want to take risks can look at target maturity funds. For others who can take some amount of risk, and remember that when you invest in investment linked insurance, they also invest into equities, right? It's not that they only invest into bonds. So if you can take some risk, another product which I think works very well for any investor is a balanced advantage fund, which basically invests into equities and bonds and keeps rebalancing the allocation based on various market-linked parameters. And most of them have their own in-house models that they use to carry out the rebalancing. So the good thing that I like about balanced advantage funds is you're getting exposure to equities. So you're having the asset allocation being done for you, and you're getting rebalancing happening at regular intervals, which means that, when the markets are high, typically they would be rebalancing in favor of bonds and vice versa. So this is a good, both of these are good products to invest and, just remain invested for the long term without really having to do a lot of monitoring or, without having to keep checking these products on a regular basis. And that's why I like these two products a lot more than locking into any long-term insurance, because these are more liquid, can be exited at any point in time, and very, very transparent.
Okay, so that's some really sane advice coming through. Ladies, if you're listening, there are two products that Mrin has spoken about. Target maturity funds on the debt side, which will give you a safe and secure return around about 6 to 7% post-tax. And then you have the balanced advantage fund, which is also, something that invests in stocks and equities as well. So you have a sort of a balanced portfolio. Mrin, it's interesting that you talked about balanced advantage funds. Generally, equity is a product that women are hesitant to invest into. If a woman wants to invest straight up into equities, right, what should her strategy be? How much should she invest in balance advantage funds? Any other funds that you would suggest?
Okay, so first and foremost, I don't recommend investment into stocks directly. The reason being, or even stock baskets for that matter, the reason being that it's very difficult for individuals and lay investors to really evaluate stocks. I mean, there's so many stocks. How do you figure out what to buy? How long to hold it to, regulate your exposure to stocks and sectors, right? And of course, what do you do in volatile times? What happens if the prices fall? Do you hold on? Do you exit? Do you buy more, right? And of course, the capital allocation that is required for stocks is much higher. So I don't recommend investing in stocks at all, or stock baskets for that matter. I basically recommend sticking on to mutual funds simply because these are professionally managed. You have a lot of low cost options available, which are very, very tax efficient. Now, in terms of what are the funds, right? So I would certainly say that if you want to do a pure equity fund, the easiest thing to do, and if you believe in the India story, is to look at the Nifty 50 index fund. It's the easiest thing to invest into. There are many different funds that are available. I mean, there's a fund available from practically every fund house in the Nifty 50 category. So look at investing into a Nifty 50 index fund. And then as you go along and get some experience, you could also look at mid-cap funds. You could look at a flexi cap fund, which invests in a combination of large cap, mid cap, small caps, and maybe international stocks. That depends on the fund. But you'll get a good exposure to all of these market caps as well through a flexi cap fund. So I think all you need, a woman needs in her portfolio of equity funds, which are easy to invest. You can just, if you, provided you choose them right, you can just remain invested for the long term, would be a Nifty 50 equity fund, index fund, flexi cap fund, and a mid cap fund.
Okay, that's keeping it plain and simple, ladies. You don't have to make it complicated. If you want safe, secure returns, just get into an index fund, perhaps a flexi cap fund, and maybe a mid cap index fund as well. All you're doing is benchmarking to the index, and hence you're sort of, riding on the India growth story, as Mrin was saying. Mrin, we need to take a short commercial break, but I'm very interested to know what else should women be doing with their money. So we'll come back in just minutes from now. Stay tuned.